This will be a brief demonstration of the Tariff Impact Calculator that I recently built into the valuebridge.net website. It is designed to help you either predict or explain how various tariff-related factors will change a private equity investment's fair market value. To start, you'll need to plug in three capital structure metrics: the GP or fund's equity value, total shareholder equity, and net debt. Three income statement metrics: revenue, gross profit, and EBITDA, and optionally the prevailing market valuation multiple for your industry or sector. Then you can go up to the top and start twisting dials to see what happens to your equity ROI. For example, let's say that tariffs increase the average unit cost, and then we respond by increasing prices. But this causes the company to sell fewer units. Perhaps there's also a modest change in SG&A, and then, due to uncertainty in the M&A environment, broader market valuation multiples go down, and so does the company's valuation multiple. Right here, we can immediately see how these factors impact the return, and when you scroll down to the bottom and select the model, you generate a value bridge that quantifies all the sources of value change. They include pricing, volume, gross profit margins, operating expenses, market multiples, the company's relative valuation, gearing, which is how much debt on the balance sheet has amplified equity gains or losses, and cash flow generation. Below the chart, we have a table with absolute dollars of value creation for each value driver. And then we have relative value creation, which is the percentage of equity value change. Below that are equity return multipliers, which combine to produce a multiple of invested capital. Then we have an annualized return measurement that works like an IRR. And finally, there is times money value creation, which is a measurement that's sometimes used in academic and industry studies. If we wish to save this analysis with all of the inputs and outputs, we can click right here to print to paper or PDF. Now, you can use this model to predict future equity values, but the results will only be as accurate as your predicted assumptions. I think that it'll be far more meaningful to do this analysis about a year from now when you can look back at real changes in portfolio company financials. This will provide an accurate explanation of how tariffs have challenged the company, what you did to respond, and how those efforts flow through to equity ROI. That's something that I think might fit very nicely in an annual meeting presentation or a fundraising deck. Let me click Reset to clear these numbers so we can provide a few examples with realistic data. First, let us consider cost of goods sold. If 25% of the company's inputs are exposed to a tariff increase of 20%, then the average unit cost would increase by 5% as follows. This reduces the fund's equity value by minus $9.12 million or 7.6%. When we scroll down to the income statement, we see that the gross profit margin decreases from 62% to 60.1%. COGS increases from 38 to 39.9, and EBITDA decreases from 30 to 28.1. Turning on the chart shows that 7.5 of the loss comes from lower gross profit margins, and another 1.6 comes from gearing because the modest leverage in the deal causes equity to fall a bit faster than the enterprise value. Now let's go back up to the top and try to offset higher costs with higher prices. We will also increase the average unit price by 5% as follows. This actually raises the fund equity value by $14.88 million or 12.4%. Down here on the income statement, the revenue increases to 105, so the gross profit margin goes back to 62%. However, SG&A has remained the same, so the operating expense margin, which is SG&A divided by revenue, decreases from 32% to 30.5%, and this is a good thing. When we go to the chart, we no longer have any gross margin expansion because the gross profit margin remains flat. But we do generate a positive 6.2 from the price increase, a positive 6.3 from operating margin reduction, and now positive gearing of 2.4. Here, the leverage caused the equity to grow faster than the enterprise valuation. Okay, now back up to the top. Let's say that for our company, we're operating under conditions of unit elastic demand. So the 5% increase in price causes volume to go down by 5% as follows. Now the fair market value of the fund's investment is basically flat. It's down, but only by about $800K. Below on the income statement, revenue, gross profit, and EBITDA are almost unchanged, and so are the margins below that. When we go to the chart, we see an increase of 5.8 due to better unit pricing, the decrease of 6.1 due to lower volume, and the other value drivers are basically de minimis. So we are almost back to par, and that's what we should expect to happen. If our unit price increase happens to be exactly the same as our unit cost increase, and we have unit elastic demand. But there are other tariff-related factors, so let's go back up to the top. Tariffs typically would not increase operating expenses directly, but maybe 20% of the company operates overseas. If there is a relative weakening of the base currency by 10%, this could cause SG&A to increase by 2%, which would reduce the fund's equity value by $3.84 million. Down on the income statement, this increases the company's operating expense margin from 32% to 32.7%, and that's not a good thing. In the chart, this creates an additional loss of $2.9 million from operating margin reduction. Okay, one more trip back up to the top. Let's say that all the uncertainty around tariffs decreased broader market valuation multiples by 10%. This is something that you might estimate from public market company comparables or take from industry data providers who track private equity M&A multiples like PitchBook or GF Data. Now, we can also decrease the company's valuation multiple by 10%. This would reduce the fund's equity value by minus $17.86 million. But depending on relative tariff exposure, the company's valuation change may be different from the market valuation change. So let's just say that it decreases by 5%, leading to a smaller investment loss of only $10.85 million. We can see how this plays out down in the valuation section. The market multiple decreases 10% from 8.0 to 7.2. The company's valuation multiple decreases 5% from 6.0 to 5.7. And the company's relative valuation, which we measure with mu, actually increases from 6 over 8, or 75%, to 5.7 over 7.2, or 79.2%. This increase in relative valuation generates intrinsic multiple expansion, which allows us to separate the broader market valuation driver from those that are specific to the portfolio company. We can see this all play out in the chart. A total tariff-generated loss of $10.85 million is explained by an improvement in pricing, a reduction in volume, no change in the gross profit margin, but higher relative operating expenses, a big reduction in broader market valuations, a comparative valuation improvement relative to peers, and a slight extra loss due to gearing. One final point, this model does not automatically adjust the company's balance sheet for tariff-driven changes to company cash flows, but you could do that manually up here. Let's say the tariff causes the company to burn an extra $2 million of cash, so we can increase net debt from 30 to 32, and that will appear down below as a negative cash flow generation value driver. So that is a general overview of the Tariff Impact Calculator. I hope that you found this helpful. If you are interested in this sort of thing, make sure to check out valuebridge.net. There I will publish a case study that explains all the math behind this calculator, and also provide Microsoft Excel templates that you can use as starting points for your own tariff impact models. Thanks for watching, and see you next time.